Jeffrey, welcome back. It's good to talk to you again.
Thank you for having me.
10 years. Wow, that's a long time. Why today?
Well, it really is this recent leg down, I think, is just at this point has really completely discounted the risks. And, we lay out in our note that although there's a lot of potential unknowns, so to speak, as we work through this balance sheet, we think the stock at this price is discounting about $32 billion of unanticipated negatives. So if we load the balance sheet with everything we know and work through the valuation, what else bad do I need to happen to solve to the $7 and change we were at last night? It's $32 billion. So, we are just at a juncture here now where we think the market has gotten, too concerned about some things. And, some of the things on the balance sheet have been a bit blown out of the proportion. And you've had, obviously, forced liquidations, tax loss sellings, and a whole litany of things that brought us to this point. So that's really the timing of the call. But the fundamental backdrop behind it and coming off the sidelines is this idea that there is now a massive cushion in the valuation relative to where the stock is trading. Yeah.
You're not concerned at all then, that when Larry Culp, the new CEO, came on this network, he really was unable to say, this is as bad as it gets or this is the bottom, et cetera. The visibility wasn't there, it didn't seem like. That doesn't concern you?
Yeah, that was not a good the Q3 earnings call was not good. That was not a good interview. Clearly, he was still getting his arms around things at that point in time. I expect to hear something different in January. Not that the problems will have gone away with the wave of a wand, but a very decisive view of where he stands and how he's moving forward and what the issues are. And I'm hopeful that he'll lay those out on the table. So even though I've got this $32 billion hole that I think the stock is discounting, whatever the number is, let's get it out there. I think one of the fundamental problems with GE here for the better part of 2 years is we've been waiting for a reset, right? You're waiting for Immelt to come off as $2. You're waiting for Flannery to clear the decks. Why isn't he cutting the dividend? Now, why isn't he cutting it enough? They just need to rip the Band-Aid off and get it over with and lay it out clearly. And I think we're going to get that in January.
Appreciate it very much. I thank you for your patience. Busy with the Fed, obviously, coming up. But we're glad you were with us today. We'll talk to you again soon. Okay, 10 years on the sideline. You own the stock?
I do not. No, I own puts in this stock. I still own 7 and 6 strike puts in here.
I knew that. I'm sorry.
And I think that there still is some downside. I like this move today. We're actually seeing people selling what's called, strangle, Scott. They're selling the upside and selling the downside, and they're collecting that money, and they're saying, hey, look, we think this stock is stuck in what's called a grind for a long, long time. Yeah. This upgrade wasn't something that made me feel like, this guy absolutely loves the stock. He really, first of all, it was minimal in terms of any kind of detail. That was
$11 price target.
Okay, so he went from 10 to 11, but other than that, what did he really say? He said, well, some of the cash flows would be better.
The market's discounted way too much negative news.
Right.
Well, stocks come all the way down.
Yeah.
It's not unlike the Tusa point of view.
What about, right. So it's not overly bullish, in other words, right? I mean, right now.
Can you be overly bullish on this thing?
No. And here's the question I would have. Would you rather own the bonds right now or the stock? The bonds were all the way into the 60-cent range, and now here they are. They've recovered some. But I wonder, in terms of upside right now, which is a better bet? I'd go with bonds.
Give me 30 seconds, Josh.
I would just say you're in a market now where some of the best names in the world are down 20%. What are you looking at this for?
There you go.
Everything's a relative. You have X amount of dollars. Why wouldn't you want to buy better companies that are down because of global fears than arguably the worst company on the market?